Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Lisa Zarlenga, a partner at the law firm of Steptoe & Johnson. We'll be talking about taxation of cryptocurrency, one of the most complex and timely issues in tax policy today. Before joining Steptoe, Lisa was legislative counsel at the Treasury's Office of Tax Policy. She has her LLM from Georgetown University and her JD from The Ohio State University. She's also clerked on the U.S. Tax Court. And full disclosure, Lisa and Steptoe represent interest in the crypto and blockchain industries. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of the screen. The event's being recorded and we posted online at TPC's website in the near future. We're using captioning, which you can adjust or turn off with the live transcript button at the bottom of the Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Lisa Zarlenga, welcome to The Prescription. It's great to see you.
Thank you, Howard. It's great to be here. Thanks for having me.
So let's start at the beginning. What is cryptocurrency?
So cryptocurrency, well, let's start with the definition that the IRS has given, and the term that it uses in most of its guidance is convertible virtual currency. And it defines virtual currency as a digital representation of value that functions as a medium of exchange, a unit of account, and a store of value. And they also add on this convertible notion, which refers to virtual currency that has an equivalent value in fiat currency or that acts as a substitute for fiat currency. Cryptocurrency is really just virtual currency or digital currency that's encrypted with cryptography. So it's sort of the technical way that it gets done.
And how is it acquired and traded?
How is it acquired and traded? Basically, you need to have a wallet in order to hold cryptocurrency. And a wallet can be a hardware wallet, like a thumb drive. It could be a software wallet, just a piece of software. You can also hold it through a cryptocurrency exchange, which also provides custodial wallet services. And so they'll provide services to hold. And basically all the wallet does is hold, it's a big password. It's a combination of letters and numbers, and the wallet just holds that password. And you can transfer it by, you can transfer it through an intermediary, such as a cryptocurrency exchange. You can also do it peer-to-peer. As long as the recipient and the transferor have the wallet addresses, they can make that transfer on the blockchain. Anybody can actually access the blockchain and see what transactions are being added to the blockchain.
So at the highest level, we'll get into some detail, but at the highest level, how is it taxed?
At the highest level, it's taxed as property. The IRS and Treasury issued guidance back in 2014, which says that convertible virtual currency is treated as property for tax purposes, not as currency, because it doesn't have legal tender in any jurisdiction. And so it basically says that any rules that would apply to property transactions, such as sales or exchanges of property and the like, would apply to transactions in virtual currency.
So to put it in as simple as terms, if I use $20 in cryptocurrency to buy lunch, that's a realization. And I'm taxed on the difference in the price I paid for that unit and its value at the time I bought lunch. Is that right?
That is right. If you spend your cryptocurrency, if you convert it into fiat currency, if you exchange it for other virtual currency, you're going to recognize gain or loss on that transaction.
Now, I understand there's also an exception to the realization rule for crypto, and that's sale of virtual currency held in inventory by a trade or business, and that's treated as ordinary income. Is that right?
That would be correct. Yes.
Okay. So that's the basics. Now, the issue of the day, or one of the issues of the day, is reporting. And the Senate Infrastructure Bill requires some new reporting requirements for cryptocurrency transactions. But the language of the bill and the interpretation of the language by its sponsors may differ a little bit. In your view, what does the amendment require?
So the amendment, the amendment or the actual bipartisan infrastructure legislation?
The amendment that's attached to the Senate version of the infrastructure.
Okay.
The Portman amendment, right.
So basically what it would do is 5 different things. The thing that's gotten the most focus is to expand the definition of broker under the 6045 regulations, which provide the rules related to broker reporting. So you get your 1099-B every year for your stock trades and everything. I think people are used to seeing that. It would expand that reporting it would expand the definition of broker to any person who is responsible for regularly providing any service, effectuating transfers of digital assets on behalf of another person. That is the thing that's gotten the most attention. And we should circle back to that because I do sort of want to talk about how that relates to current law. This bill does several other things. It also treats digital assets as specified securities for purposes of those reporting rules. And basically what that does is it extends basis reporting to digital assets. The third thing that the statute does is to expand the broker-to-broker statements in section 6045 Cap A to provide digital asset brokers with the information received from other brokers. So right now, if you have your stock held at a brokerage and you transfer it to another brokerage account, that broker the transferring broker has to give a statement to the recipient broker about what the basis is, when it was initially acquired, all the information about that security. They would extend that rule to digital assets. And basically what that does is facilitates the basis reporting for crypto brokers. The fourth thing that the legislation does is to add a new requirement to require information reporting for digital assets that are transferred from a broker to a non-broker account. So if you're transferring it to, say, a personal wallet of the customer or to some other account that's not held at a brokerage. And then the final thing that the legislation would do was expand the reporting of cash payments over $10,000 that are received in a trade or business to digital assets. So there's actually quite a bit that and then one other thing, there's no inference language in the legislation with respect to whether any person is a broker or whether any digital asset is a specified security under prior law. And that one has me scratching my head a bit because I think that it's very unclear. And in my view, I'm not sure that the current regulations extend to cryptocurrency reporting. And so I think that the IRS and Treasury has some challenges trying to apply those rules retroactively. So I was a little surprised to see that no inference language.
So one of the issues in this Portman legislation has been whether reporting would be limited to brokers or whether it would require reporting from other actors like hardware developers or miners. The legislative language seems ambiguous. Senator Portman says it does not include them. Is that acceptable? Is the legislative history that he created acceptable, or does the industry still feel a need to have this further clarified, perhaps in the reconciliation bill that we might see sometime in the fall?
So I think it's helpful. I think the statements that have been made by Portman and other senators have been helpful, but I think there's still some concern that when Treasury implements it, that they could go further than what Portman might be thinking. And the concern that you mentioned, the language refers to brokers that provide services with respect to effecting transactions. And so that language is, could potentially apply, like you said, to, miners and stakers and other validators. They perform a service. They perform actions that are needed to verify the block of transactions that's going to be added to the blockchain. They don't have any insight into what the transactions are. They verify the transactions from a technical perspective, meaning that they verify that the transactions comply with the protocol and can be added as a block. You also mentioned the hardware and software providers. If you provide, those USB ports to, to serve as wallets, you're selling that. You don't know what the user is going to do with it. You have no insight into the transactions that are conducted, by that customer. And developers, software developers that actually create the protocols for the use or transfer of digital assets. One might think that those developers have some control over the protocol and over the the blockchain that's being used to transfer the assets. But what happens in practice is a lot of these, they don't want to have control over it. They want this to be open source blockchain. They issue what are known as governance tokens, and then the governance tokens, everything's run by software from there. The whole protocol is run by software. And in order to change anything, you have to get a majority of the governance tokens to, to sort of vote to change something. And so there's concern among the industry that those kinds of players could be swept into the language. And I will note there were statements made on the floor. There were also amendments that were introduced, and this was sort of an interesting frenzy at the time, that this bill was, for the vote-a-rama. You had a series of amendments. You had Senators Wyden, Loomis, and Toomey that introduced an amendment that would have clarified that those three classes of participants, the verifiers, the hardware and software providers, and the protocol developers, would not be treated as brokers. Then you had another amendment that came out from Senators Warner, Portman, and Sinema, which would have only protected miners, not even stakers or other validators, and providers of the hardware and software wallets. And then finally, those two groups got together and reached an agreement upon amendment that would have actually narrowed the language in the definition of broker by removing that providing any service language, and would have also clarified that all validators and providers of software and hardware wallets would not be considered brokers. Now, for procedural reasons, those amendments didn't get a vote, but it's part of the history.
So back to the kind of bottom line question, from the industry's perspective, is this going to need to get cleaned up maybe in the reconciliation bill? It appears that they're not going to reopen the infrastructure bill. So do you think this needs to get cleaned up legislatively?
Well, I would say the industry is interested in having it cleaned up legislatively. They would like it to be crystal clear to Treasury and the IRS as they implement this, what is meant by it. I think even if that doesn't get enacted, that would be sort of the ideal to get that legislation clear, but barring that, I think then the industry just needs to educate, Treasury and the IRS as to how these actors operate within the ecosystem and what information they have access to. I think that, the current regulations under 6045 are drafted in a way that applies to brokers in a traditional sense, persons acting as principals or agents that effectuate transfers on behalf of customers. If the government takes that same approach with respect to digital assets, then I think in the end, they're going to be fine. If they start getting very aggressive and tries to reach some of these other players, then I think that there probably would be some issues. And potentially if they actually do try to cover, for example, miners, miners would have to change the way they operate in order to comply and to be able to collect the information. And, rather than do that, I think that the miners are just going to go offshore and set up their operations somewhere else.
So let me take it back to brokers for a minute. So as you mentioned, 6045A already requires brokers to file information returns. We know this in the context of stock trades and that sort of thing. So if it's already got the authority, does the IRS really need legislation? It's been working on guidance in this area for a couple of years. Could Treasury just do this unilaterally without a statute?
I think the answer to that is yes. The statute broadly defines broker to include any person who acts as middleman with respect to property or services. Well, as we mentioned at the outset, virtual currency is treated as cryptocurrency is treated as property. And clearly some of these centralized exchanges, such as Coinbase or Kraken, are middlemen with respect to those, to those property. And I think that, the centralized exchanges are fully expecting to be subject to broker reporting. And the IRS and Treasury have been transparent in the fact that, this has been listed as a project that they're working on the priority guidance plan for the past 2 years. And so they clearly think they have the authority already to apply it. I would agree with that. I think the way the regulations are currently drafted, it's much narrower, and I think arguably does not reach cryptocurrency transactions. So I do think that they need to change the regulations, but I think they have the current authority to do that, which had me kind of scratching my head at the 28 billion price tag that joint tax put on it, because I don't know how that scoring goes, but I would have thought if they already had the authority to do that, that wouldn't be treated as a revenue raiser.
Yeah, it makes me wonder whether or not this whole argument is really about the $28 billion and not really about the substance of requiring reporting.
Yeah,
I guess I could.
It would be helpful, potentially for Treasury and the IRS to sort of get it, to have it clearly provided in the statute that they can apply this to digital assets. That way that, when they put out the regulations, they're not going to get challenged, that it's clear from the legislation.
So we have a question from Mike Udell, who's one of our audience today. Does the Senate proposal conflate reporting under 6045 for broker reporting with 6041 for payments received in a trade or business? If an owner of a wallet transfers virtual currency to another owner of a wallet in a business transaction, and neither are brokers, should not that transaction be reported under 6041?
So interestingly, I think the guidance has come out basically in the initial guidance known as 2014-21 and the FAQs. They basically indicate that taxpayers have to comply with already existing requirements, as they would have to if they made any payment in cryptocurrency or in property. The notice and the FAQs refer specifically to reporting on Form W-2 or 1099 MISC if you pay compensation in cryptocurrency. The guidance also mentions 1099Ks, but none of the other reporting is mentioned. And I would say that, right now there's no uniformity regarding reporting among the cryptocurrency exchanges or other intermediaries. So some exchanges, such as Gemini and Binance US, report on a 1099K. Coinbase used to provide 1099Ks, but now they do 1099 miscellaneous for income related to, airdrops and forks and staking rewards. There are some exchanges out there, such as Uphold and Cash App, that provide 1099Bs, and then some that don't provide any information reporting. But I do think that if you are paying someone in cryptocurrency, and they would otherwise have to report under 1099 MISC and satisfy those rules, I think that they currently have to be satisfied. Where I think is the big question now is 1099B reporting. In my view, the regulations don't clearly extend to cryptocurrency reporting. And so it's really hard to say that the current 1099Bs extend to cryptocurrency reporting.
So I think you raised another really interesting issue here, which is not just the cacophony of interests here, but just the number of different crypto coins. I mean, everybody knows about Bitcoin, but my understanding is there's somewhere between 4,000 and 6,000 different crypto coins, depending on who's counting. Each of them is somewhat different. And we saw the IRS try to address this in recent guidance on like-kind exchanges, where they said, well, this may apply to some coins and not to other coins. Is this sustainable, really? Or at some point, are we going to have to sort of sort this all out?
Well, I mean, I think by kind of adopting a broad definition and saying it's all treated as property, they don't have to necessarily decide how each individual coin is going to be treated. I think at some point, one of the things that the guidance doesn't do is say what kind of property cryptocurrency is. So you have some code provisions, for example, that turn on whether something is a commodity or a security, and that guidance hasn't been provided. And you can analyze. I mean, I know we've seen some. In my experience, I've seen token issuers, for example, where we're providing advice on how to treat the tokens, and we basically need to look at the token and say, what are the rights and obligations that are reflected in this token? What do they look the most like? They could look like a security, they could look like you know, a commodity. They could look like some other type of property. They could look like inventory, depending upon, you know, how it's treated. And so right now, I think we find ourselves in that, you know, where we're trying to analyze each one individually based on the rights and obligations that it issues. You know, I don't see that changing anytime soon, because I don't think that the IRS and Treasury are kind of going to try to wade into trying to say, well, this particular crypto is going to be treated as a security. This one's going to be treated as commodity. If anything, I think the industry is hoping for some broad guidelines as to when something falls within one of these categories of property. And I would say recently too, you have this, you know, incredible rise of non-fungible tokens, which presents, you know, even more complications, because the use cases for these tokens is changing so much and evolving.
So if they're non-fungible, are they still an asset and not money? What are they?
I would say they're still treated as property. You know, I think that the early adopters of non-fungible tokens have looked a lot like, you know, art and collectibles. You know, they have, they represent an ownership interest in a piece of art, for example, a digital piece of art. And so they look a lot like, you know, a collectible. But I think you're going to start seeing, you know, anything that's customizable can be done as a non-fungible token. And so I think you're going to start seeing all these different tokens appear. And, you know, and like I said, the easiest way to deal with them is going to be to try to provide some broad parameters of what constitutes a commodity, what constitutes a security, what constitutes just regular property, what's an intangible, what's, you know, so I think that additional guidance would definitely be helpful in this area. Mm-hmm. I don't see them treated as other than property.
So back to reporting, you know, there's been a lot of focus on the illicit uses of crypto. But it strikes me that there are responsible investors out there who are trying to figure out gains and losses on their own, which must be very difficult. And it seems for them, better coordination and data sharing between brokers, miners, nodes could make filing a lot easier. Is there a role, do you think, for the industry? I know that there's a sort of a kind of a sense of sort of independence here, but is there a sense where the industry can play a role in bringing some order to this? And actually the political question is, does the industry understand that if it doesn't, the government will?
Yeah, and I think that at least the larger exchanges seem to get that. You know, we've seen them evolve from not really providing any kind of information to their customers to, as a customer relations issue, providing them sort of transactional data so that at the end of the year, they can download that data into a spreadsheet and figure out their taxes. And so we're starting to see many exchanges do that, regardless of whether they're doing information reporting to the IRS, they are at least providing this information to their customers. And I think a lot of them see broker reporting as you know, kind of the right thing to do for their customers, and are you know, are expecting to have to do it, but are also, you know, also think of it as being helpful to both, you know, to both the IRS and to their customers, I think mostly.
Mm-hmm. So let me switch gears a little bit and ask you about a related issue, which is DeFi, or decentralized finance. How does that fit into the picture? So their analog is a bank, but like crypto brokers are not exactly the same as banks. How are they different, and how does that affect their tax treatment? And just to ask a specific question, think about something like yield farming. Users deposit their crypto assets in a DeFi protocol and earn rewards, and those are lent to other DeFi platforms that earn more rewards. Sounds like bank interest, but is it really? Is it taxed that way?
Well, I think the IRS and Treasury will probably take the position that it is taxable income. I don't know if they treat it as interest or what, but it seems like it would be ordinary income, like interest or like a dividend or something like that. You know, I think that the challenge that's presented by DeFi is, you know, I mentioned earlier, sort of decentralized exchanges or peer-to-peer exchanges, and how do you actually implement reporting with one of those? You know, they are, there's no person, there's no entity that's actually facilitating these transfers. They're all done by, you know, by smart contracts and by, computer programs. I think eventually the protocols will be programmed to be able to collect information and to automatically report it, and it'll make life very easy for everyone involved. But right now, I just don't think the technology is there to actually facilitate that reporting. And so right now, it's kind of incumbent on the user to be able to kind of keep track of all of those, all those income events. And if you're staking your cryptocurrency, for example, those income events could be, hundreds of times a day. And so it could potentially be, quite burdensome until the technology kind of catches up with where the government, I think, ultimately wants to go.
So you recently edited an ambitious book that takes readers on a worldwide tour of crypto taxes. So my challenge to you is, can you summarize in just a couple of minutes how the rest of the world taxes cryptocurrency?
Well, I would say that there's no one way, no one approach. But one of the things that surprised me the most in doing this book is that there was a remarkable number of jurisdictions who treat cryptocurrency as property. And so it sort of confirmed that the US is not alone in this, whereas, you got a lot of people in the industry saying, well, this is just like money, you should be treating it as money. I think the majority of the world's jurisdictions also don't treat it as money. There are a couple of outliers. But then you have a range of approaches in terms of, timing when it's going to be taxed. The IRS, at least, in its hard fork guidance, seems to be leaning towards immediately upon any event. When it's written to the blockchain, it's taxable. You have some jurisdictions that, don't tax the cryptocurrency until it's actually transferred in a transaction. So if you're a miner and you receive a mining reward in the form of cryptocurrency, it's not going to be taxed until you actually transfer that. And I think a lot of people in the industry in this country think that there's some benefit to that. That there's a simplicity. The value has kind of settled. It's still volatile, but you have a better idea what the value of what you're dealing with is, and you don't have you've received something. You can cash it out if you want to, but some of these transactions, doing it right when it's written on the blockchain, it creates some challenges, and so it's something that Treasury and IRS might consider for simplification purposes, if nothing else.
So we have just a couple of minutes, and I want to ask you another international question. So the Biden administration reportedly is already considering a worldwide information sharing system for crypto transactions. Look a lot like the reporting that foreign banks must do for accounts that are currently held by Americans. I wonder where you think that's going to go. And even beyond that, do you think we'll eventually see a BEPS-like process that the OECD is currently undertaking with corporate income tax, where we get an agreed upon set of consistent multilateral tax rules for crypto? Is that really where we're headed at some point?
I think probably so. I know the OECD is currently actually studying information reporting as it relates to digital assets. They're looking at what other countries are doing. And I think they're planning on coming out with kind of a CRS type of proposal for digital assets. I know right now too, they're studying what the US is doing in its activities, because right now we don't follow CRS. We have a different, sort of a different system. And so they're looking at what we're doing with respect to digital assets, they're also looking at what other countries are doing. So I do see us as going there sometime where we'll have a international exchange of information and some sort of information collection on various crypto transactions.
Well, we are out of time. There's so much more we could talk about. Maybe we'll have you back again and kind of keep going on this. Lisa Zarlenga, thank you so much for taking the time, and thanks to our audience for listening.
Thanks for having me.